Every time an economic crisis hits, we're given the same explanation. We're told it was extraordinary, unpredictable, an economic accident. But history tells a different story. For more than 200 years, financial crises have repeated themselves. They arrive in different forms, but follow the same pattern. From traditional banks and capital markets to crypto and stablecoins. This is not a coincidence. This is not bad luck. The problem lies at the very core of the financial system itself. Modern economies are built on a fragile foundation. Money that can be withdrawn at any time, yet is used for long-term investments. As long as this foundation is misunderstood, as long as banks and financial systems are treated like ordinary businesses, crisis is not a matter of if, but when. And now there is only one question left. Have we truly learned from past crises? Or are we simply waiting for the next one to arrive? Every time a financial crisis hits, it is described as a disaster. As if the economy simply had bad luck. As if this were a rare event. But historical facts tell a different story. For centuries, financial crises have repeated themselves. They come and go, separated by relatively similar intervals. Almost every generation experiences one. If something happens once, it may be an accident. If it happens again and again, it is not a coincidence. It is a sign of a flaw within the system itself. This means crises do not occur because of a single person's mistake, nor solely because of war, pandemics, or new technology. Those are only triggers. The deeper problem lies beneath the surface. The way our financial system is designed makes crises possible. So the real question is no longer, why did this crisis happen? But rather, why do we keep allowing the same system to run again? If we trace every major financial crisis in history, from the 19th century to today, one recurring pattern becomes clear. The root of these crises is almost always the same. Short-term debt that can be withdrawn at any time. To the average person, this sounds safe. We deposit money in a bank and trust that it will always be there. But the reality is different. Money in a bank does not simply sit still. It is lent out for mortgages, business loans, and other long-term investments. This is where the problem begins. The assets are long-term, but the owner's claims are short-term. As long as everyone believes in the system, it appears stable. But once doubt appears, people stop thinking rationally. They start thinking about who gets out first. This is what's known as a bank run. And history shows that bank runs never truly disappear. They only change their appearance. In the past, they looked like long lines outside bank branches. Later, they became panic in the repo market. Then they spread to money market funds. Today, they take a more modern form, digital stablecoins. The technology becomes more sophisticated. The speed becomes faster. But the logic remains the same. Once trust breaks, money moves faster than the system can respond. And that is when we relearn an old lesson. Financial crises are not about failed innovation, but about collapsing trust in a system that was fragile from the start. We are often taught one simple idea. Transparency is always good. The more open something is, the safer it becomes. But in banking, reality is not that simple. Banks are not ordinary companies. If a shoe factory goes bankrupt, the damage is limited. Workers lose jobs. Owners take losses. And the story ends there. But when a bank starts to fail, the impact can spread across the entire economy. People's savings, the payment system, even national stability can be put at risk. That is why banks are often described as special institutions. Banks operate on trust. As long as people believe their money is safe, the system functions normally. But that trust is extremely fragile. This is where the paradox appears. In the middle of a crisis, if all bank data is fully disclosed, if every number is exposed without context, the public does not become calm. They panic. Not because the bank is certainly failing, but because they fear others will panic first. This is why, historically, banking systems have always relied on a degree of opacity. Not to deceive, but to prevent mass panic. Total transparency may sound ideal, but in times of crisis, it can become the spark that sets the entire system on fire. In banking, too much light at the wrong moment can cause everything to collapse. Every time a crisis hits, the response pattern is almost always the same. Governments and regulators move quickly to rescue banks that appear to be in trouble. Capital injections, bailouts, emergency mergers. At first glance, this seems reasonable. Save the banks, and the system should be safe. But this is where the major mistake lies. Regulators too often focus on individual banks, not on the system as a whole. A bank can look healthy on paper. Strong capital, balanced balance sheets. It passes stress tests. But the financial system is not a collection of isolated buildings. It is more like an electrical grid. One failure can trigger outages everywhere. When all banks hold similar risks, rely on the same sources of funding, and are tightly interconnected, individual strength no longer guarantees collective safety. History shows that many crises erupt precisely when almost all institutions are rated as safe. Time and again, regulators repeat the same mistake, putting out small fires while ignoring the fact that the entire forest is already dry. As a result, crises may be delayed, but they are never truly prevented. Every time a crisis ends, we tell ourselves that we have learned. New rules are written. New technologies are introduced. The terminology changes. But beneath all of that, the fundamental mistake often remains the same. Modern regulation looks more sophisticated, faster, more digital. This includes new financial systems such as stablecoins. Yet on closer inspection, many of these innovations still rest on the old foundation: short-term debt. That depends entirely on trust. As long as the systemic design does not change, as long as risk is merely shifted rather than eliminated, we are repeating history in new packaging. Crises do not happen because we lack intelligence. They happen because we are too confident. And history has proven one thing: as long as the same mistakes are repeated, crisis is not a matter of probability, but of time. The question is no longer whether the next crisis will come, but when, and in what form. In the end, financial crises are not about numbers, charts, or complex terminology. They are about how humans build systems of trust, and how those systems collapse when trust disappears. History has issued its warning time and again. Not with loud alarms, but through patterns that repeat themselves. As long as we refuse to understand the root of the problem, as long as our solutions only patch the surface, crises will always return. In different forms, with the same victims. So the question now is simple: have we truly learned from past crises? Or are we merely waiting to be surprised by the next one again?